Hey everyone, and welcome back. In this video, I will be talking about oil. Now, in my most recent analysis on natural gas, I had mentioned I suspect the Biden administration is artificially suppressing energy prices ahead of the midterms, the reasons being obvious, and that includes oil. Now, a couple days ago, the Kingdom of Saudi Arabia actually released a letter confirming that suspicion. So here it says the Kingdom of Saudi Arabia confirms Biden attempted to coerce them to postpone oil cuts until after the midterms. Well. And where does it say that in the letter? I believe right here. The government of the Kingdom of Saudi Arabia would also like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside the OPEC Plus group regarding the situation in the oil markets, the government of the kingdom clarified through its continuous consultation with the U.S. administration that all economic analyses indicate the postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. And just to provide some background, OPEC Plus had a meeting last week where they agreed to cut global oil supply by approximately 2 million barrels. I believe that was the number. And that target is to be held through the end of next year. At least that's their initial target. We'll see if that changes. Regardless, the Biden administration was not happy with this news, and it seems that they went back to OPEC Plus and tried to persuade them to delay this decision for a month. Well, what's in a month? The midterms. So this is like irrefutable evidence that this administration is directly tampering with energy prices. And if that's not enough, well, the White House also is considering an export ban ahead of the midterms, just to have prices go back up afterwards. I mean, but regardless, this administration is desperate. And why are they so desperate? Well, let's take a look at this chart of the national average gas price. Now, as we can see here, it was getting crazy in the summer, and then around June, we began to have one of the longest consecutive declines in the price of gas. And the reason why is because this administration authorized massive releases from the Strategic Petroleum Reserve, or the SPR. So they just flooded the markets with more oil, and that actually triggered OPEC Plus. They saw exactly what the US was trying to do here, which kind of explains why they went ahead and did what they did. Regardless, the prices came down a lot due to the releases. Now, it's important to remember that we are going to have to replenish those reserves at some point, and it seems that this administration will do that, well, after the midterms, in case you still don't understand. Now, recently, and this is why the administration is getting desperate, is because we are seeing a turnaround, obviously, and the prices are going back up across the country. In fact, some states like California have actually already surpassed the record they saw around June. Regardless, prices across the nation are going back up, and it's not the best time for that to be happening since we're already halfway through October. Add on to that the fact that not only are crude inventories near record lows, refined inventories are also way below average. Now, what I mean by refined is that you can't just take crude oil out of the ground and then put it straight into your gas tank. You have to refine it into gasoline first. Now, if you need it for your plane, then you need to refine it into jet fuel. If you need it for your truck, you need to refine it into diesel. All these inventories are also near record lows, and that's not good. Add on to that, you have China, which, they're still under pretty strict COVID restrictions in many parts of the countries. Should any of those be relaxed, you're going to have a lot of upward pressure on the price of oil. Because again, remember, this is all about demand and supply. And right now, we just don't really have the supply factor here that's sufficient enough to meet all this demand that we are seeing and we are going to see going forward. This is a point I made on previous videos. There is not enough investment into this sector. There's simply not enough investment nor the infrastructure to meet all of the demand. And just because you make the investment or start infrastructure projects, etc., it takes time. Okay, it's not something that just happens overnight. So the supply that we need, I mean, even if we start today, we're not going to see it until like a year or more out. So that is a major problem. So in the short term, at least, we are going to see a shortage of oil and other commodities. You can take advantage of the situation because this is bullish for oil and other commodities. So how can you play this? I made a video on XLE before. XLE is a energy sector ETF, and it honestly has been a safe haven amidst this very, very bad market. S&P 500 and the Nasdaq, they're both down over 20% year to date. XLE year to date is over 40% in the green, not in the red, in the green. Which, you know, it's not surprising if you understand, even just to a little degree, what's going on in this sector. But still, it is admirable to say the least. So there's that. You can also play individual names like MRO, which I've been talking about and personally invested in. But if you want to play the commodity itself, you can do the futures. Obviously, that is up to you. But if you want to play it but not through futures, you can also use UCO. So this is basically another leveraged ETF. It's like the cousin of BOIL, which is the leveraged bullish ETF for natural gas, but this one is just for crude oil. I believe that this might go down like a little bit more here just because of everything we've seen in the markets recently. I suspect next week could be pretty bearish given everything that's going on. But honestly, even if we don't see that, these prices that we are seeing here, it's not bad at all. And honestly, the risk is to the upside. The bears have some very short-term advantages here with the midterms coming up. But after the midterms, we already know pretty much what's up here. So we are basically getting prepared here in advance. And, you know, honestly, I would like to see this below 28, but even at this price, it's not bad. So definitely, I'm most likely gonna try to take a position here sometime next week. We'll see. And yes, I understand that the market is pretty bearish right now, but again, given the circumstances surrounding both of these commodities and other ones, I believe you can see gains here despite what we're seeing in the overall market. So even though there might be some short-term pain, again, there's no guarantees, and this is not financial advice, but I am speaking more so for the medium long-term period. Take of it what you will, but that is pretty much it. If you guys have any questions or comments, feel free to reach out. Please like, share, and subscribe, and I'll see you all in the next one.